Welcome back to the Market Insights webinar. This is Kevin Prince from BMO Exchange Traded Funds. We're so pleased that you join us each week to get some insights to the overall market and specifically around exchange traded funds. Our focus for today is really going to be more about staying invested, as well as we want to give you an update in regards towards the election and the session we had just 2 weeks ago. So with that, let's get started. First, our disclaimer, of course. Really what we're trying to give you here is some market insights, not specific advice, nor recommendation. We always encourage you to seek professionals for those specific recommendations. And then, of course, let me introduce my guests today. Alfred Lee is going to join us. He's a portfolio manager and ETF strategist for BMO Exchange Traded Funds. And Mackenzie Box from our product team join us today. So thank you very much for taking the time to join us. And again, we talked about doing staying invested, but before we go into that, I want to highlight some tools. And I like to say that I got a feedback from a question saying, how come you don't talk about your own tools? Okay, thank you for the question. Appreciate everybody sending questions in, and please do that as a response towards this session too. We love those questions. They really help us build our content going forward. Thank you for that. So the question really says, how come you don't highlight your own tools? Well, let me quickly do that if you don't mind. On our public website, free tool, easy to access, no sign in whatsoever. You can go click on a little button there that says tools. What can you do when you get there? Well, you can actually take a look and compare any ETF in Canada to any ETF in Canada. And so we're showing you a cute little chart here on the side that just showing you the comparison most recently of the asset allocation ETFs in Canada, the VBAL, the XBAL, and the ZBAL. You can do that there. Now, even addition beyond that, just showing the depth of this tool for you, what you can do is actually look beyond performance metrics, but look at other key metrics around the exchange traded funds, whether it's the fund data, the market data, the holdings, all those key metrics are available for you on a side-by-side comparison, really making it very easy to do your analytics. And then one more thing that I really think is a nice value add. If you take a look at those tickers across the top where it says VBAL, XBAL, ZBAL, you just click on those tickers and up comes a one-pager snapshot on the respective ETF. We're showing you here one on Vanguard, gives you some insights specifically in regards towards that ETF. And one last thing I like what it does is it actually gives you a direct link to that website, even if you want to go down even further in detail on your analytics. So I encourage you to take a look at bmoetfs.com and take a look at our comparison tool there. And thank you for the question. With that, let's get into the main topic. The main topic today is staying invested. Now, Alfred, we've certainly seen a lot of reasons out there not to be invested. Maybe give us some of your thoughts to kick off this conversation around staying invested.
Sure. I think as you mentioned, I think staying invested is very important for the long-term performance of the portfolio. I think very often we could get caught up in headlines. So obviously, as you mentioned, the headlines right now is the U.S. presidential election. So as of right now, it's still not decided. But obviously, a lot of people are concerned about, how that's going to play out. What's the ramifications on the portfolio? Should you stay invested? Should you pull out? But very often, I think, as investors, we get too caught up in the headlines. I think, as the people that do report the headlines are media. So their job is to get viewership. So because of that, negative news is always more attractive or attract more viewers or readers. So at the end of the day, I think, headlines are just headlines. Every year, there's always a negative headline that could, give you reason to either not stay invested or to hold off in investing. But, year by year, staying invested over the long term, I think, is the main goal for investor. Usually it works out. So just taking more recent history as an example, in 2008 during the recession, I remember in 2009 when we were coming out of the recession, people were doubting the rally in the stock market, saying that it was becoming disconnected with the underlying economic fundamentals. The market continued to rally. 2010, people started becoming concerned about the sovereign debt crisis, and then it was the Eurozone crisis, the U.S. fiscal cliff in 2012, which turned out to be a non-event. And then the Fed started talking about tapering, and then the market started cooling off. And then they were concerned that that was the end of the credit cycle. So As I mentioned, I think every year there's always a reason not to invest, but over the long term for investors, staying invested over the long course is usually the right answer.
Thanks for that, Alfred. Now, we certainly have gone through the last week and the week now, pretty much been up and down. Kind of feels like a little bit of an emotional roller coaster. Mackenzie, let me bring you in on this. Give us your thoughts about this emotional roller coaster.
Sure. Thanks, Kevin. And thanks everyone for joining us today. And when it comes to investing, emotion impacts a lot of the decisions we make, and it also impacts the way we think. And I think this graphic does a really good job showing that. This was actually something put together by a Nobel Prize winner, Kahneman, which really depicts the emotional roller coaster you go through when investing. And if you think back to this year, we started off strong in the market, COVID hit, up came the anxiety and everyone kind of rode down. Then we had a sense of, relief, some optimism in the market. And it really is a toll of emotions. So when we looked at this, research actually shows that we fear loss twice as much as we do as the equivalent gain. So when you think about that, it doesn't fully make sense, but it can really impact the way we make investment decisions and ultimately impact our overall returns and limit us from reaching our investment goals. And as Alfred alluded to, we turn on our TVs, we read the newspaper, and we're inundated with all sorts of headlines that impacts the way we think about our investing and impacts our thought process. So in today's environment, you really want to be mindful of where you're getting your news from. Is it a valid source? Make sure it's a balanced source, and kind of make sure you're taking a long-term view, because that short-term noise will give you some emotion, but it's important to take a long-term view and remove emotion from it.
Thanks for that, Mackenzie. And I think you're right. I mean, that fear of loss versus fear of greed, that's a hard thing to get beyond sometimes for investors out there. The other thing too, I guess, to think about too, in these kind of markets that are volatile for that matter, give us your thoughts on maybe concentrated versus diversification and how that can help out. Bring that slide up too.
Yeah, sure. So just kind of building off the last slide, the saying, don't put all your eggs in one basket, couldn't be more true. And I think when it comes to emotion, like we were talking about, the more concentrated you are, the more likely your emotions are going to be impacted. So that kind of brings us to the point that diversification is really key. And I know we've touched on this in a few different sessions, but spreading your investments across various asset classes can really help protect your portfolio while also leaving room for some upside. And this chart shows various different asset classes and how they've done over the last 10 years. And I mean, no one has a crystal ball. We don't know what's going to perform each year, but what we do know is that a diversified approach with a right asset mix help maximize your potential returns.
Thanks for that, Mackenzie. And I like how you also included a balanced portfolio in the middle there, the gray boxes, just kind of highlighting what the balance does versus the individual parts of the market. So Alfred, going to you for a second, because I've been glued to CNN for the last few days here. So one of the things I think is this CNN fear and greed index too out there, and that's a big emotion for a lot of people out there. Talk to us about that from a staying investor perspective.
Yeah, I think as we've been mentioning, you shouldn't make investing too emotional. As Mackenzie pointed out 2 slides ago. Very often, I mean, the short-term news is very emotionally driven, right? Over the long term, it's important for investors to stay the course. Very often, I've talked to investors where, when the market sells off, they decide to pull out of the market thinking that, the market's going to drop out. And then when they move to cash, the market starts to rally the next week. The market recovers and it continues to rally. They start thinking to themselves, well, if the market pulls back from here, what I'm going to do is, wait till then until I reinvest. But what tends to happen is that the market continues to rally and rally and rally, and never does it go back to the point that they exited. So, timing the market is extremely tough. On the flip side, a lot of times when the market continues to rally, a lot of investors have said, you know what, this is really a disconnect with the underlying economic fundamentals. So I think the market's going to, the end of the cycle is coming soon. So I'm going to cash out. And then what happens is the market continues to rally for years and years, as we saw, in 2018 or 2017 to 2020. So it's very tough to time the market. As they often say, one quote that I've come across that I think especially rings true is that they say, the market could remain irrational far longer than you could stay solvent. So I always thought that was a good term because it's a good saying that keeps investors in check and lets them know that never get too emotional and always staying the long term or staying the course over the long term usually wins out.
Thanks for that, Alfred. And you know what? Building off that, you're right. People get that aspect of saying, I want to go to cash because that fear and greed aspect is really just playing on their minds. And then going back to Mackenzie's point, that emotional roller coaster. Let me bring up a chart that I think really kind of speaks towards that and the concept of staying invested. Let me give you some background on what this chart you're looking at right now. What we're seeing there in that both lines are the TSX Cap Composite Index. So the red and the blue line. What's the big difference? Well, the blue line is basically staying invested. The red line is saying, okay, at that bottom point there where you just couldn't handle anymore, you cashed it in. And then you got the all clear signal. And basically about a year later, he said, I'm going to get back in 100%. And yeah, it's a scenario. We're just walking through a concept here, but effective, you take a look at it, even after the most recent market correction in March, when the chart stops, you can clearly see that the person that got out of the market and didn't get back into the market till a year later and got that all clear signal will never catch up to that other person. So that's the benefit of staying invested. Yeah, you can jar your lines wherever you want longer, but it's still the same kind of outcome here, is that staying invested helps you attain those goals long term, and it's really hard to get caught up once the market moves in its direction. So think about that from a staying invested perspective. Mackenzie, let me finish off with you some final thoughts and staying the course.
Yeah, and I think Kev, that example you showed as well as this really speaks to, and I'm sure you've heard the saying, it's not about timing the market, it's the time in the market that pays off in the long run. And just looking out here, you can see there's examples of some different market events that have happened over the years, but over the long term, staying invested pays off and helps you reach your financial goals. So, you're always going to hear the short-term noise. There's always going to be headlines. Like Alfred said, there's always going to be reasons not to invest, but over the long term, you really do benefit.
Thanks for that, Mackenzie, and thanks for that, Alfred. Now I want to shift gears because I want to give everybody a little bit of an update and some of their thoughts of our session we had just 2 weeks ago. And we're talking a little bit about the U.S. election. Certainly had a lot of questions in regards towards it, so let's talk to that. Now, this is the most recent snapshot from this morning. Alfred, I don't know if anything changed yet, but we're watching this all with bated breath. What's going on? Wall Street Journal, nice little image from your website, actually showing the graphic of the by electoral ballot. Alfred, let me come to you on this one and simply talk about a scenario update because we outlined 3 different scenarios. Where are we leaning here, and what's your thoughts?
Yeah, so coming into the elections, we outlined 3 scenarios. So these are the 3 scenarios that we thought were the most likely. Those are still potentially, those are potential outcomes still. So, the first outcome is the Democratic sweep, the blue wave. So that's, Biden winning the White House, and then Democrats keeping the House and then taking the Senate as well. So far they've locked up the House. So that is a done deal. But what's looking like the most likely scenario, at least right now, and it's too close to call, is scenario 2, which is a Biden victory and then a divided Congress. So that means the Democrats keep the House and then Republicans keep the Senate as well. Scenario 3 is the status quo, which is Trump winning, keeping the White House, and then Congress remains the same. As I mentioned, I think, scenario 2 right now looks like the most likely scenario. Right now, it's still pretty close to call as of right now. I think it's really up to 3 states that have swung towards Biden's favor. That is Georgia, Nevada, and Pennsylvania, but they're all within, between, I think, 1,500 votes to 20,000 votes. So it's still really close to call right now, and all 3 potential outcomes are still possible. But what we did here was we outlined the 3 scenarios, and then we highlighted, the policy changes that investors should be keeping an eye on, and then parts of the economy that could potentially benefit and parts of the economy that would be negatively impacted based on those various outcomes.
So thanks for that, Alfred. Let's dive into a little bit more detail because we can certainly see what it hurts, the energy, the technology, pharmaceuticals, domestic equities, but let's take a little more detail into the benefits. And can you dive into that for a little bit, where themes you're seeing?
Yeah, so I think, as I mentioned, I think right now it looks like scenario 2 is the most likely. But again, it's still too close to call. But let's take scenario 2 as, your hypothetical example. I think a lot of the key themes are probably likely anyway. So again, scenario 2 is, Biden taking the White House and then Senate, Republican, and then the Democrats keep the House, which has already been confirmed. But some of the things that investors should be focusing on is, if the Republicans keep the Senate, a lot of the tax hikes that the Democrats were pushing potentially get warded off, given that the Senate is controlled by the Republicans. And keep in mind, with the Senate, that's the only area in which you could filibuster any kind of bill or act, meaning that you could delay or postpone any kind of act or bill that gets pushed through. In addition to that, I think there's going to be a lot of, because we have a divided government, I think, there's going to be wrangling from both sides. But I think one area that both sides could agree on is technology and infrastructure. So they're certainly going to, disagree in terms of, where to spend it, how to spend it, and how much of it to spend. But overall and broadly speaking, I think these are areas in which they could focus on. And last but not least, I think, this outcome, scenario 2, potentially is an area which could create a lot of volatility based on, compared to the other 2 scenarios, essentially, because as I mentioned, with the Senate and the Republicans keeping the Senate, that's the only area in which you can hold up a bill or enact, which is called filibustering an act. So if that's their only source of power, then that creates potentially a lot of gridlock, meaning that potential volatility can arise from that. So we outlined, based on the 3 different scenarios, ETFs that investors may want to consider or could be well suited for those specific themes. So based on scenario 2, ones that I thought were interesting and have done well historically are things like low volatility ETFs. Banking sector has done well, as Mackenzie pointed out in her asset allocation slide. Balanced themes or balanced portfolios tend to be pretty consistent over time and perform well over many different scenarios and markets as well.
Thanks for that, Alfred. Now, taking a little bit deeper, you mentioned volatility, right? And certainly last week and relative to this week, we're certainly seeing volatility come back. Give us your thoughts on that on a go-forward basis.
Yeah, I think overall, a lot of investors are focused on the headlines right now, and as we mentioned at the top of the call, sometimes it's just headlines, right? And over the short term, it's just noise. Over the long term, I think what's been weighing on the market more so is coronavirus. I think we have to at least kind of get that under control. I think over the long term, that's going to create more volatility. But even when you look at things over the long term, so in the last market cycle, for example, since 2008, what we noticed was that low volatility stocks did tend to outperform during that cycle. And I think the big part of that is because, when you look at where the investable assets are held, Generation X and baby boomers essentially hold up to 80% of all investable assets. And as we know, those 2 cohorts are essentially aging at this point. They're de-risking their portfolios and moving into less cyclical stocks and less risky stocks as they de-risk or prepare their portfolios for retirement. So because of that, low volatility stocks or ETFs have been well positioned for this kind of a market, and also other factor-based ETFs such as quality-based ETFs that focus on blue chips has also been well positioned for this kind of economic climate as well.
Okay, Albert, but you're thinking volatility is still going to be strong for a while. So let's say people want to, instead of mitigate it, want to participate in it. What's your thoughts around that?
Yeah, so I think one way to get volatility to work for you is covered call strategies. So covered calls, I think, is a very unique strategy. It's well suited for this environment for a number of different reasons. One, you can get volatility to work for you. So with a covered call strategy, let's go through the basics. It's essentially, you own the underlying stocks, and then in order to enhance the income in that portfolio, what you do is you write call options against these positions. So by collecting the premiums, you enhance your yield. So using ZWB, which is the covered call banks ETF as an example, the underlying banks pay a 5% dividend, but then by writing the call options, you annualize another 3% in yield, which is taxed as capital gains. So you enhance your yield, which is well suited in this environment because the higher the volatility, the more premiums you earn from writing those call options. But it's not only well suited because you use volatility to work for you, it's also well suited for this environment because, as we all know, when you look at the bonds and the yields that we're seeing in the fixed income market, they've been compressed to all-time lows at this point. So when you're looking at a balanced portfolio where income has tended to come from the fixed income portion of your portfolio, now, however, fixed income is not generating enough yield. So you need the equity portion of your portfolio to make up for that yield shortfall. And that's where covered call strategies make sense. They essentially make up for that yield shortcoming that is a result from the low interest rate environment that gives you lower coupons in the fixed income side of your portfolio.
Yeah, insightful. I mean, you're right. I mean, you get two kind of thought processes: mitigating and participating. Hey, Alfred, let's talk about, you've done some history here, talk about the various scenarios now, but talk about what it means for the market on a go-forward basis. And you did a nice chart up here, and I really appreciate that.
Yeah, I think, a lot of people, especially if you're watching the news right now, I mean, it's the only headlines that you're seeing is, what's going to go on with the U.S. presidential elections, what are the various outcomes, who's going to win the White House, how is Congress going to be divided. But, as we've been mentioning, I think, over the short term, it's just really noise. If you look at historical returns of the market, no matter, which scenario is the outcome. So right now, there's three possible outcomes. Equity returns have been favorable over the long term. So I think a lot of times people make too much about, who's inside the White House and who's in power. At the end of the day, I think, the economic cycle is much more important. That means, looking at what the Fed is doing with interest rates, what the monetary policy is, how far along are we in the credit cycle, and, what kind of measures central banks have in place. So non-conventional measures such as quantitative easing, that has far more impact on the stock market than actually who's in power in the White House. So as we've been saying all along, over the long term, staying invested is more important. And over the short term, a lot of the headlines that you're seeing in the news is really just noise.
Thanks for that, Alfred. And just as quick as we close off before we shift into the questions, just want to close on just a relook at the same slide we had before, because I really think it highlights this concept of staying invested and really what it means for the long term. Yeah, sure, tilt the portfolio, change the portfolio as you see fit, but certainly thinking about the long-term implications of staying invested. So let's shift gears and let's pick up from the questions. And again, thank you so much for all those people out there that took the time to send a question in. We got a bunch, and really some great friendly comments too. Thank you for that. Appreciate it. First and foremost, Alfred, I'm going to start with you. This is actually a build off of your slide because the individual is concerned about the Biden presidential and what that means for their portfolio. Also a little bit of the volatility going on right now. Can you give us some thoughts in regards towards that, please?
Yeah, as I mentioned, it's just really noise over the short term. I think the market is posturing right now based on that headlines or potential negative headlines. But as we outlined in the previous slides, no matter what the outcome is, equity markets over the long term have historically been strong, no matter who's in the White House and how Congress has been divided. So over the long haul, as we've been saying all along, even though a lot of people are concerned about who's in power, is Republicans better for the market? What happens if Democrats impose a tax? Staying invested over the long haul, and all outcomes have been favorable for the stock market overall.
Thanks for that there, Alfred. Now, let me go to you, Mackenzie, for a second here, because this investor here, actually appreciate the kind words one more time, but this investor here is actually not a direct investor working with an advisor, but they're really trying to get the understanding of, are ETFs available beyond direct investing? And maybe then too, Mackenzie, if you can talk into a little bit about the differences between the active and the passive approaches that you normally find in a mutual fund or an ETF, active, passive too.
Yeah, sure. So ETFs are not just for direct channels. They've actually been used by institutions for quite some times, and they were actually the first adopters of ETFs. And now over the last little bit, we've seen advisors and do-it-yourself investors become heavy users as well. So they are accessible, kind of no matter what channel you want to go through. Now, active ETFs, they are managed by a portfolio manager on a regular basis. You just want to keep in mind, you always want to look under the hood and really see how active it is, and understand the strategy, because that's always important, making sure you know what you're holding, versus some of the strategies are not always as transparent. So I encourage you, if you are comparing or if you're looking at an active strategy, just make sure you're looking under the hood and really understanding the strategy. And in regards to ZBAL, so good news, Kevin spoke about our ZBAL and our tools up front. And one thing that you can do on our tools, if you ever want to compare an ETF versus a mutual fund, you can actually pull in any Canadian mutual fund. So you're able to pull in an ETF and a mutual fund and compare them directly.
Thanks for that, Mackenzie. So with this individual, he's got mostly North American ETFs, and they're thinking about the diversification and hearing about the international ETFs and the international exposures. Alfred, maybe you can talk to us about that and the considerations one should make in going beyond Canada or North America itself.
Yeah, so this is a good question. I think one thing that you should consider is that when you are looking at, especially a lot of the larger U.S. companies, so companies like Amazon, Coca-Cola, Nike, IBM, they're all global companies in nature, right? So you do get global exposure, but certainly, adding, true international companies definitely helps diversify a portfolio. So in terms of, whether you should be currency hedged or not, it really depends, right? I mean, we can't see your portfolio, but it really depends on the time horizon and also your risk tolerance as well. If you have a longer time horizon, I would argue that having that currency exposure definitely is beneficial, as the more uncorrelated returns you have in your portfolio, the more diversified your portfolio is. If you have a shorter time horizon, it may make more sense in terms of using a currency hedge, because it removes one of the potential uncertainties in your portfolio, especially if your income needs are in Canadian dollar. Then if you are close to retirement or in retirement, you probably want that currency exposure hedged.
Thanks for that, Alfred. A couple more questions we can get in. Maybe go to you, Mackenzie. This person is interested. We had a couple of shows in the past about our derivatives and derivatives exposures. Where does somebody find out information of the respective ETF providers and the extent they're using derivatives? And what should they be looking for?
Yeah, that's a good question. I think one of the most important things to do is, do your due diligence before investing. You want to make sure you trust the provider and you trust the content that they're putting out there. So you want to make sure you understand the strategy and look at the content that's being provided to you. Are there white papers or fact sheets that are available or disclosed on the public website that you can actually go in and find those things? So, for example, for a lot of our covered call ETFs, we disclose a lot of this stuff on our website through our white papers and whatnot. So it's all publicly available for you. So I think, do your due diligence if you're looking at particular ETFs, trust the provider, look what's available to you, and just make sure you understand what you're investing in.
Thanks for that, Mackenzie. And I'm going to stay with you for a second here, Mackenzie, because part of the industry is about bringing out net new ETFs. It's also part of the industry is about transformation ETFs. Now, this individual holds a BMO ETF that we will be closing soon. So walk us through what your thoughts and for this individual in preparing for the termination of an ETF.
Sure. Yeah. So we are terminating a few ETFs at closer to year end. And to be honest, it really doesn't make a difference if you hold it to termination date or if you sell now. What happens at the termination date is that the money will go back into your account. So really it's your decision. If you want to control the exit, then you can sell. If not, you can hold. If you're worried about the distribution, if it pays an annual distribution, if you sell before the termination date, you won't receive the distribution. And if you hold it to termination date, you will receive it. So completely dependent on what works for you. Just keeping in mind though that, all ETF providers, as well as us at BMO, we are focused on making sure we're providing, the right ETFs to the market. Over the last 11 years, we've closed maybe 14 ETFs. So, we are committed to making sure that ETFs get a fair chance and we have the right market for them and whatnot. So just be mindful of that. The other thing too is if we, in 2 weeks from now, we have a tax loss selling webinar scheduled. So that might also be something you maybe want to take advantage of as well, just going into to tax season.
Thanks, Mackenzie, and thanks for a little shout out for what's coming up in 2 weeks' time. Last question we got coming here, just to build off of last week's session, and we had a good discussion, and I really appreciate the IIAC joining us and sharing their insights. What we really talked about there was how the ETF navigated the last little market and added liquidity to the marketplace, which is kind of a proof point to the initial what ETFs were first created for initially. First thought of, I should say. Now, the question is, how does that work? Well, think about it here. There's always two ways an ETF is trading. There's two people trading back and forth. There's also the creation of the ETF or redemption of the ETF, where the ETF is then traded against the underlying securities. So in areas when the market's moving fast, yes, the underlying is the ETF can be exchanged for the underlying, but that second layer of liquidity where the larger and more liquid ETFs in the marketplace are trading, that brings in a layer of liquidity because that's just people exchanging back and forth their viewpoints on that market. Now think about how does that work? Think about more of the concept of basket versus an individual security. Sometimes with individual securities during stressful markets, maybe they're not, maybe the buyer there at the price point that you're looking to get out at, or the market's looking to give to you, right? Ultimately, that's a challenge because if you really want to get liquidity and get out of the marketplace, you're going to have to take that price. The benefit of the ETF is because it's a basket, the basket tends to be more liquid than the individual security. And that's what helps the individual investors provide more liquidity to the marketplace. Because if you're looking to express a viewpoint in the S&P 500, out of the S&P 500, for example, putting a basket on will be quicker because you're not buying 500 securities, but B, instead of having to wait to get access to one of those 500 securities, you're getting the basket on at once. So it really is a complement to the overall marketplace itself as a diversification tool, the basket more liquid than the individual. Anyway, hopefully that helps. Thank you for everyone once more time for all the good questions this week and the nice comments too. Very much appreciated. We're going to be back next week again at 1 o'clock for Market Insights. Next week, we're going to take some time and discuss the new asset allocation ETFs that are entering the marketplace. Certainly become very popular investments. Let's take some time and dive into those. Thanks so much. Hope to have you here again next week. Cheers.